Hi. Now today I would like to discuss corporate earnings in the US, Europe, and China and what that means for investors. Now let's start with the US. Year-to-date equity performance have been overwhelmingly driven by changes in valuation multiples. In the US, first quarter earnings results were stronger than consensus estimates, helped by the resilience of profit margins. Despite the earnings surprises over the past couple of quarters, US 2023 earnings per share growth expectations has been steadily downgraded over the past couple of months, and this could continue. Now, with headline inflation easing off, but continued concern about the recession lingering on, the headwind on earnings may be shifting from higher input costs to a slowdown in economic growth. This may mean that pressures on both profit margins and top-line revenue growth going forward. For Europe, European equities have benefited from an improvement in economic backdrop supported by a fall in gas prices, as well as optimism around China's reopening. As a result, there were upside surprises in the first quarter 2023 earnings in Europe. Now looking ahead, although stubbornly high core inflation may put pressure on margins, we think there remains some bright spots in terms of earnings backdrop in Europe given the benign economic environment. For example, the benefits of China's reopening and also the prominence of bank stocks within European indices as rate continues to stay high should help European earnings in the coming months and quarters. In China, Chinese equities have returned negatively year-to-date. While valuation multiples have contributed negatively, earnings growth expectations for offshore equities have been mildly positive. The de-rating of valuation multiples is mainly driven by subdued business and consumer confidence, as it is sensitive to global sentiment and global flows. However, as MSCI China is heavily geared towards consumer and technology-related stocks, it benefits from the reopening and also the loosening stance of gaming and tech regulations. Earnings expectations for China is still high despite the downgrades over the past few months. Unless there's a material positive shift in confidence as well as upbeat guidance from management, there could be further scope for earning downgrades in the near future. Now, what does that mean for investors? For developed markets or economies like the US and Europe, varying phases of economic cycle as well as monetary policies coupled with different severity of level of banking sector stress suggests investors should look to diversify geographically. Now, even though the market has lowered its overall US recession probabilities on limited sign of a credit-induced contraction within the economy against still resilient labor market as well as housing data, we continue to focus on quality stocks in both the US and Europe as the global economy sees slower growth and lower inflation. Now, within Asia, Chinese equities have been disappointing so far. International investors have remained on the sidelines until they see more clarity on the economic and geopolitical developments. Yet, we remain optimistic about the sectors of strategic importance to the government, such as renewable energy, electric vehicles, technology developments, including artificial intelligence and cloud computing.